Okay, so good morning, everybody, and welcome to this panel, and thank you for your presence. It's a pleasure to take part in this panel organized by the Observatoire de la Finance, jointly with the University of Fribourg, Gdańsk University of Technology in Poland, and Environmental Defense in Canada. I'm Virgile Perret from the Observatoire de la Finance, where I'm responsible for managing the Global Prize on Ethics and Trust in Finance for a Sustainable Future, while developing research on monetary innovation, financial digitization, and sustainable finance. So our topic today is on exchange-traded funds and their impacts on sustainable development. As you have probably noticed, the exchange-traded funds universe has seen impressive growth in recent years, both the number of ETF and the value of assets under management have risen dramatically. At the same time, the sustainable finance market is growing rapidly, with investors increasingly focusing on ESG factors in portfolio selection and management. Exchange-traded funds that track ESG criteria, although still small in size, have the potential to grow into a mass market investment vehicle for sustainable development. However, sustainable ETF need to overcome a number of challenges to become a meaningful financial vehicle for sustainable development. So to discuss this important topic, I'm pleased to welcome and introduce our speakers for this panel, which aim to assess and discuss the socio-economic impacts of ETFs. So first, Adam Marszk, who is Associate Professor at Chair of Economics at Gdańsk University of Technology. His research focuses on financial innovations, financial markets, and sustainable investing. Adam Marszk is a CFA chart holder and member of CFA Society Poland. Also welcome to Ewa Lechman, who is an economist, associate professor also at Gdańsk University of Technology. She concentrates on digital technologies, economic development and growth, fintech, and she completed international research and publication on these topics. We also have a remote speaker, Julie Segal from Canada. Welcome to Julie. She will appear on the screen just a few minutes after. She's a senior manager at Environmental Defense in Canada. She advances climate-related financial policy. Julie Segal previously managed a portfolio of impact investment and is recognized for integrating environmental justice into sustainable finance. She's also the winner of the 8th edition of the Global Prize Ethics and Trust in Finance for a Sustainable Future. Welcome also to Paul Dembinski, who is the initiator and director of the Observatoire de la Finance, professor at University of Fribourg. The mission of the Observatoire de la Finance is to promote awareness of ethical concerns and activities in financial activities and professions. Since its foundation in 2007, he co-chairs the jury of the Global Prize Ethics and Trust in Finance for a Sustainable Future. So the panel will be divided in 4 parts. First, we'll have the presentation of Professor Marszk and Professor Lechman, who will present the forthcoming book on exchange-traded funds and their impact on the sustainable development. Then we will have the presentation of Julie Segal, our remote speaker from Canada. She will broaden the discussion on the impact of ETF. And then we will take questions from the audience. So please don't hesitate to prepare questions while you are listening to the presentations. And finally, we will have conclusive remarks by Professor Paul Dembinski. So thank you, everyone. And I will give the floor to Adam and Eva.
Okay, so we are just waiting for the presentation to come on the screen. Okay, so thank you very much for the introduction. We are very happy and honored that we can be today with you during the Building Bridges event. Thank you very much for Observatoire de la Finance for organizing this session. Together with Eva, we'll talk briefly about the results of our research project. Research project focused on sustainable investing, exchange-traded funds. Of course, the project is much broader today due to the time limitation. We just showed the selected results. focused on the socio-economic impacts of exchange-traded funds. So this will be the main issue covered within this presentation. As it was already mentioned, the presentation is related to the book that will be published soon, within a few months, at the beginning of 2023. On the screen, you can currently see the cover of the book entitled Sustainable Investing, the Socio-Economic Impacts of Exchange-Traded Funds. Just to give you a brief background, the book is a result of the research project conducted here in Switzerland at the University of Freiburg, starting in October last year and concluded a few days ago. Also, some parts of the project were co-financed by the National Science Center of Poland. So again, we will discuss just some selected results of the project. If you are interested in obtaining more results, in reading the draft of the book, please contact us. We will try to provide you with all necessary materials. So before we present the results of our empirical study, I would just like to give you a brief introduction to the topics covered within the book. So a few sentences, a few remarks about ESG and sustainable investing. What we can notice quite clearly, and I think this event is one of the best pieces of evidence for that, is the rising popularity of sustainable investing. Of course, it is also proven, for instance, by the growing assets of sustainable investing strategies globally, as well as the increasing number of academic studies. So from academic perspective, it is also a topic attracting increasing attention. Of course, another support for this claim, for the claim of the growing importance of sustainable investing, is increasing interest of investors. As you can see on the graph provided on the slide, this is taken from the report by Standard Chartered, the share of investors being at least aware of the features of sustainable investing is growing. However, there are still some issues concerning sustainable investing that remain relatively understudied, and one of them is the topic that will be discussed today, that is ESG, exchange-traded funds. Just one methodological, terminological comment throughout the presentation. We will use the terms ESG ETFs and sustainable investing ETFs as synonyms. Of course, some could claim that there are some minor differences between those two terms, but they are relatively insignificant from the perspective of our study. Going back to the topic of the significance of ESG ETFs, they are already declared by some reports to become potentially a very important tool in the context of sustainable development. As we can read in a report published in 2020, they can be mass market investment vehicles supporting various aims of sustainable development. Why? Due to their high accessibility and ease of access. And the growing interest in ESG ETFs is already noticeable when we consider market data. For instance, here you can see the data on 2021 flows to ETFs. In European region, as you may clearly notice, the market was divided in this dimension, half by half. So half of the funds were allocated in conventional non-ESG ETFs, whereas the other half went to ESG ETFs. Of course, when we consider other regions, the situation is not so optimistic. This led to the geographical focus of our analysis, which is Europe, because Europe is simply the most developed market globally for sustainable investing ETFs. The other reason why we focus on the European market is, of course, the institutional background, in particular various public policies related to ESG. I will not describe them in detail because probably everyone in this room knows at least a bit about those policies. So just to mention their names: European Green Deal, accompanied by the European Green Deal Investment Plan, as well as the EU Taxonomy Regulation. So this document that may seem mostly technical can have significant impact also on the development of the European ESG ETFs. So the question that we asked and tried to answer through our empirical analysis was whether and how European ESG ETFs are able to influence the socio-economic systems and also to some extent the environments of the European countries. So we needed to identify some channels of transmission, and probably the most important one is through the impact of ESG on companies. There are many publications, there are many studies devoted to this topic, so after extensive literature review we were able to identify the key channels of the key mechanisms of transmission between markets for ESG ETFs and other parts of the economy. So those elements, just to give you the main ideas. So the first element is, of course, active ownership, taking part by the managing companies in the meetings of shareholders, influencing the decisions that are made during those meetings, such as the decisions to make changes to the board of directors. Of course, those decisions, the possibility to exert such influence is limited by the necessity to have enough votes during the meeting. Some other possibilities in this area include stewardship codes, as well as entering informal dialogues with the company or other investors, again to influence the decisions, the actions of the company to make them more sustainable. According to the review of the literature, to the previous empirical studies, we can state quite clearly that they show that companies that are relatively more ESG compliant than competitors can reach certain benefits. For example, then they can gain access to cheaper financing, they have more loyal customers, or the securities can reach higher levels of valuation. The increasing importance and the role of ESG is also noticed by the companies themselves. According to this survey conducted by Deloitte, as we can see, the majority of the company surveyed declared that they observe the positive impact of ESG on their actions. So to conclude this more theoretical introduction, we can state that, and this is one of the main ideas in the discussion about sustainable finance, we can state that sustainable investing can potentially be a contribution to the processes of sustainable development, mostly through the impact on the companies, such as the mechanism that I just described. On the other side of this relationship, because I described mostly the positive effects, there can of course be also negative consequences for the companies that are relatively less ESG compliant, such as facing barriers in accessing finance. And the final part about the background of our analysis, of course, what also needs to be taken into account is the regulatory framework, because it affects the relationships that are addressed in our project. Another element of the determinants is obviously the motivations of investors. Actually, one part of our project was devoted to the analysis of the factors affecting development of ESG ETFs in Europe. Of course, this will not be presented today. Again, if you are interested in this topic, please contact us. So going to the results of our project, we will discuss the results linked to two research aims. The first one, quite briefly, it is the analysis of the development of ESG ETFs in Europe. And the second aim is the key one, so this is the examination of the effects of their spread in the socio-economic and environmental context, also taking into account SDGs and European policies concerning sustainable development. Very briefly about our data set, we managed to identify, according to the criteria established, all ESG ETFs primarily listed in Europe. So our final sample consisted of over 600 funds as of September 2021. I will not discuss our methodology because, of course, this could be the topic of the next presentation, next meeting. The indicator that we focused on with relation to the development of ESG ETFs was total net assets in two perspectives. One of them was simply the value expressed in certain units of currency, and the second one was the share of ESG ETFs of their assets in the total assets for ETFs primarily listed on certain markets. So ESG ETFs plus conventional ETFs. The time coverage 2006-2020. And the final sample, as you can see, consisted of 5 European countries. Why? Because those are simply all countries for which we could identify a more significant number of ESG ETFs primarily listed on the local stock exchanges. Now I will give briefly floor to Ewa, who will describe the research methodology of our analysis.
Okay, thanks Adam, and hello everyone. Here I will very briefly tell you what kind of research techniques we have been implementing to check whether the ETFs have any kind of impact on social, economic, environmental, but also financial areas. So first we have been using a very basic descriptive statistics to show what were the maximum and the minimum observed values of certain factors we have been analyzing over the period in scope, but also to know what were the average values of elements we have been testing. This was complemented by the non-parametric graphical evidence, which can which can visualize what are the statistical relationship and associations, mostly between ETFs, growth, and the other elements we have been confronting ETF versus. Then we have been using more advanced techniques, which in here, of course, I will leave aside all the mathematics that stands behind, but we have been using the panel regression analysis, where the main aim, the main focus was to, well, we were trying to capture what is the impact, but of course the impact in statistical terms. We have not been testing the causality per se in here between ETFs, treating always ETFs growth in terms of value traded as the factor that has potential impact on 3 different areas of social, economic development, of financial development, but also the most important in here, the environmental one. What is important in here, and also it should be stressed that the models we have been using, they control over the unit, so the country, and over time biases. So all this has been captured in these models, but the results briefly I will show you after.
Okay, so the first, as I mentioned, there were 2 aims in this part of the project. The first aim was related to analysis of development of ESG ETFs. The first slide that you can now see on the screen is the total value of assets. So those are all ETFs primarily listed in Europe. As we can clearly see, the development was quite substantial in the period of 2006-2021. But what is even more important is, of course, the development of ESG ETFs, here presented in the 2 perspectives that I mentioned. So the first perspective, this is the solid line on the screen, is the value of assets, in this context expressed in US dollars. And the dashed line is the share of sustainable investing ETFs in the total assets of ETFs primarily listed in Europe. So maybe omitting the differences at the beginning of the period, what we can quite clearly see is the rapid development starting from approximately 2017. And as you will see in a minute, this is the result that holds for almost all countries in our sample. The geographical structure is following. As you may notice, that the market was quite concentrated. Most assets of sustainable investing ETFs were located in the United Kingdom, followed by Germany, so those are 2 biggest markets. Then we have also France, Switzerland, and something that we call Euronext non-Paris. So those are exchange-traded funds primarily listed on Euronext, but not on its Paris segment, which is here called France. Then Italy and Nordic markets, but in the other countries, the values of ESG ETFs were very low, or there were even no such funds available. So when we take into consideration the development paths for certain markets, I will show first the results for those 2 countries, just to give you to give you a better insight. So we can see again, taking into account France and Switzerland, the beginning of this period of expansion of this category of investment funds. Again, as for the results for the entire region, it is approximately 2017. And despite some differences, those are the results for also for the remaining countries. In all cases, we can see that somewhere between 2016 and 2018, the rapid development started. How can it be explained, for example, by referring to the changes in the policies enacted at the European level, also by generally increasing demand globally for the sustainable investing financial instruments. And now I will again give floor to Ewa, who will describe the results related to the second empirical.
Okay, thanks, Adam. Okay, here I will briefly show you and explain what can we conclude basically from our first correlation analysis. So here we have, without setting you the certain numbers of or the value of or the correlated elements, and the correlation coefficients. I have summarized the for which factors, for which variables correlated versus ETFs, we have noted positive and strong correlations, and we have found that ETFs growth value has been correlated positively with 16 out of 26 examined variables, out of which we have found for 10 of them that the correlation has been strong, meaning that we have noticed first that the correlation is statistically significant, which implies definitely something, and the value of the coefficient has been below 50%. So the co-movement of the variables is observed in this case. The highest value, it was close to 0.7, of the correlation coefficient has been observed for renewable electricity output, which means that we have, over the analyzed period in these economies, you have observed that along with the growth of ETFs, we are also observing the growth of renewable electricity output. And on the right-hand side, you have summarized the variables for which we have identified negative correlations, so also the co-movement, but in opposite directions, of course, in terms of the values observed. And you have observed negative correlations in terms of 10 out of 26 examined variables. Meanwhile, the strong negative correlation has been observed for 6 variables, and these are, out of which 5 are, let's say, environmentally related, which is quite important information in this case. And the highest correlation, negative correlation, has been observed for CO emission, which is going down along as the value of ETFs is going up. And in this case, the correlation has been noticed for something like 0.18, so 80% of statistical association has been observed in this case. Okay, and then briefly telling about the results of the panel regression analysis. As I have mentioned, we have used the model capturing both over time and over units, so over stock markets and over countries, unobserved differences. But still, just to remind, in each case we have tested the impact of ETFs growth on certain variables, which are listed in here, grouped in 3 areas of financial development, socio-economic development, and environmental development. Also, what has to be noted in here, which is quite important when we are concluding on the panel regression analysis, is that the short period we have been analyzing in here is quite short. This 15 years for such type of analysis, this is not much, but of course we have been limited by the data, and as prior to 2006 we didn't have available no ETFs, yes, available for those stock markets we have been analyzing. So this is the first limitation. The second limitation that also has to be borne in mind in here is that those elements, those variables, that factors we have been testing, although we have been using some numbers and we are trying to quantify them, you have to remember that in fact, the numbers in here, it's not all, so we have to always bear in mind what stands behind those numbers. And the values used in here can be, and the elements in here, like economic freedom, for instance, or bank deposits or human development, are affected by pretty many different other unobserved in here elements, some external elements, okay? And finally, the last is that the impact, okay, not causality, but the impact in here could be not direct, okay? Also, although we assume that it is direct in here in the model, we have to remember that the links can be much further in here. Still in here, you have listed in green those variables for which we have found that the ETF's growth has a kind of positive impact on economic freedom, property rights, stock market capitalization, bank deposits, human development. And then ODA provided researches in R&D and domestic government health expenditures. Okay, in here in the second table, the results are more mixed. So we note for some the positive, let's say, impact and for some negative. Still again, what is important, in most cases, the direction of the link has been as what we have hypothesized at the beginning. So no very strong surprises in these results. Okay, and to sum up the results of this empirical analysis, what we have noticed that the strongest impact of ETFs can be observed for basically, generally speaking, the stock market developments. If we consider especially three elements, this is financial development, capitalization, and bank deposits. Next, in terms of ETF's impact on socio-economic development aspects, what has been noted that despite that the coefficients reported were positive and significant also for a number of researchers, proportion of women in management and basic digital skills, the highest impact, the highest potential impact has been observed for institutional attributes and for growth of quality of life, of course, measured in here by HDI. And what is the most important in our case, almost in all, when we have been testing the environmental factors, almost in all cases we have traced the positive impact of ETF's growth on those environmentally related areas, okay? Which does not actually mean that the sign was positive. It could be negative, okay? But as I was claiming, for instance, the CO2 emission, the growth of ETFs meant that the emission was going down. So in fact, we can conclude that the impact is positive in this case. Thank you.
Okay, so just to conclude our presentation, as I mentioned at the beginning, we tried to also relate to the framework of sustainable development. So our results mean that potentially ESG ETFs in Europe can be seen as contributing to reaching the goals of sustainable development. We listed those SDGs that are potentially affected on the slide. So those are mostly, of course, SDGs related to the financial, economic, and social systems, such as SDGs 1, 8, and 9. Why are those affected? Where is the relationship? The relationship, for example, could be linked to improvements in financial development, something that Ewa mentioned. just a few minutes ago, and also, of course, impact on the innovation-related issues, and this is related to the assets that are held in the portfolios of sustainable investing ETFs, which focus relatively more than their competitors on companies quite active with regard to innovation activities. Obviously, those results can also be considered in the context of the European policies, and maybe ESG ETFs in Europe can become one of the tools to reach the goals of the policies of the actions undertaken, such as the European Green Deal. And just to conclude, to put our research in the broader context, in the context of sustainable finance, as we have shown with maybe even many stipulations, we can claim that ESG ETFs are potentially contributors to the processes of sustainable development, at least in the European countries. And this is probably the biggest stipulation when we consider the market for ESG ETFs globally. We can see that they are available in Europe, in some North American countries, in some Asian countries, but still their assets globally are quite limited. So in order to exert influence on a broader scale, they would have to be available in a much larger number of financial systems. And of course, another problematic issue that we all deal with is the question of identification and classification of ESG ETFs and also their alignment with SDGs, not only from our research perspective, but also from the perspective of the aims declared by the funds. So thank you for your attention. We look forward to any questions, comments, and I would also like to thank again Observatoire, thank Virgile and Anna for organizing this session, and thank Professor Paul Dębiński, who was the supervisor of the project conducted in Fribourg. Thank you.
So thank you very much to Professor Marszk and Lechman for the presentation. So as I said at the beginning, now we have a broader discussion with our remote speaker from Canada, Julie Segal. She should be with us if technology is working, I hope, and if her alarm clock also works, because it's 3 a.m. in Canada. So I hope we can connect with her. Hello, Julie.
Good morning, everybody.
So welcome, and thank you very much for being with us. And I hope you could wake up on time. And technology seems to be working. You can
Absolutely.
hear us. You can hear us properly. Yes.
I can hear you well. I hope you can hear me as well.
Yes, very well. Thank you. So I will leave the floor to Julie. As I said at the beginning, she will broaden the discussion and bring more critical element on ETF. And then we will take questions from the audience, so don't hesitate to prepare any points or questions you'd like to ask after Julie's presentation. Thank you.
Wonderful. Well, I'll share a presentation, and thank you so much for having me with you today. As Virgile mentioned, it's early here, but very happy to be joining virtually and to be able to engage in the conversation. So my name is Julie Segal. As Virgile mentioned, my work is on policy for sustainable finance as well as the investor side. And today I'll be taking a bit of an alternative perspective, outlining why it would actually be quite challenging for ETFs to advance positive impacts given some of their inherent characteristics, specifically focusing on whether they can advance sustainability, advance the SDGs, positive impact. It will be a bit more of a theoretical conversation than the research, the great research that Adam and Ewa just presented. But the main question here is, can passive funds make progress? My perspective is that there's a correlation, perhaps, as demonstrated by my colleagues just before, but very hard based on the characteristics of ETFs for there to actually be causation of positive impact. So just getting my slides to work, pardon me. Great. So this is a very important conversation because global ETF assets are significant. They could pass 25 trillion USD by 2025. But we'll start by defining sustainability, ESG, and impact because as as my colleagues mentioned, those are often quite fluid in the ETF space, and it wasn't a barrier for their research, but it is very important to understand to move this conversation forward. Then discuss some of the barriers, why it would be challenging for ETFs to advance positive sustainable impact, some of the solutions, and move into a broader question and discussion period. So first, unpacking sustainability, ESG, and impact. ESG strategies exploit information about environmental, social governance factors to identify and mitigate risk in order to maximize returns. Whereas on the contrary, impact strategies or ones pursuing sustainability aim to deliver additional and intentional positive outcomes. So ESG is thinking about additional factors when evaluating financial value, whereas impact is looking to achieve things over and above financial value. A really important piece here that's relevant for publicly listed investments like ETFs is that positive impact is commonly defined as, again, being additional, so achieving something that otherwise wouldn't be, and intentional, deliberately looking to achieve that positive impact. And it's very difficult for an ESG fund that's looking to avoid risk to advance positive outcomes. So the next question is, by just considering those ESG risks, can that necessarily deliver positive impact, even if just incidental? Recognizing they're different things, but can there be some overlap? So let's go through this. Some examples. Can considering ESG risks incidentally achieve positive impacts? And this will feed into how ETFs can or can't be sustainable. From the social perspective, employment, health, and safety is an important thing to think about from an ESG perspective. It's a risk avoidance, so you'll have fewer work stops. So yes, promoting employee health and safety, a positive impact does align with ESG. Similarly, looking for women representation in management, which is again an ESG risk mitigant. You'll have twice as many clever candidates to pick from. Also advances a positive global impact. From the environmental perspective, if you're considering physical climate risks or pricing in climate risks, thinking about, is this area going to be damaged by physical climate damage, and should I therefore require a higher cost of capital? Well, no, that doesn't actually align with positive impact, because that would raise the cost of capital for most vulnerable regions. So these examples are showing that no, we cannot assume that considering ESG risk actually does lead to positive impact. Sometimes maybe incidentally, but a lot of times it's the opposite direction. So we have to be very thoughtful about that ESG funds are unlikely to advance positive impact because that's simply not what they're designed to do. Taking this a bit further, again, a fund may label itself as aligned with, for example, SDG 5, gender equality. Does that ESG fund actually align with the SDG impact? Let's say that the board or management is gender diverse, so the fund put that SDG 5 label on themselves. But if we look at the underlying targets published by the UN to really understand that SDG, it's not really talking about management or board diversity. There is one sub-target which is listed on the UN website, and really the best way to understand the details of the SDGs, which I'm sure many people in this audience know quite well. But one target here is about ensuring participation, equal opportunities for leadership. So that does kind of fit, but generally SDG 5 from a reading of the targets shows that it's more about women being no longer systematically denied equal rights as men. So it's more about rights, not just representation, which shows that the ESG lens doesn't align with the SDG impact. It can be kind of ticking the box. But if you're really defining positive impact, the ESG rating on the ETF may only be considering the governance issue and not actually moving forward the crux of the matter. So again, to sum up this part, ESG funds of any kind, including ETFs, are unlikely to directly advance positive impact because that's not what an ESG fund is designed to do. It's avoiding risk, whereas we have to look for deliberate, intentional impact strategies to advance that impact. So now that we understand kind of what that means, how different forms of sustainable investing can differ, let's examine how ETFs can make positive impacts or interrogate some of the key principles of why it's challenging for them too. So 4 main reasons that we'll go into here. First, publicly listed companies are limited for positive impact in general. Again, looking at that additional perspective that we just talked through. Second, ETFs concentrate asset manager ownership without the requirement of engagement. Third, ETFs track an index, so can they really move past that status quo? And lastly, the self-identification of ESG means inconsistency, again, as we just unpacked a bit. So first off, can publicly listed investments have a positive impact at all? Shareholders generally have low impact or influence over companies, and retail investors especially, through an exchange-traded fund, even less, because the main way to have influence as a shareholder is by using your vote at shareholder resolutions at the annual general meeting, AGM. That's the main way to have influence, but investors forfeit that through an ETF. So it's hard to advance more positive outcomes without that opportunity. Even taking a step back, if it's a positive company and you're putting more money on the capital table, that doesn't necessarily mean that there's greater volume of impact. Is your money being at the table actually creating that positive impact or helping that company do what it's doing? Not necessarily. And to make that argument, or to make this evaluation even clearer, to take a really common example, people will often cite divestment from fossil fuels, for example, saying that it doesn't make sense because if you take your money away, that harm will just go to another buyer, which has some validity because it's a public market and very liquid by its nature, and that's the benefit to investors. But that same principle works backwards. You can't take credit for the improvement. Investing in a sustainable company, putting your money on that capital table in the shareholder public market doesn't narrowly extend its benefits. And that's especially true with ETFs, again, because you're forfeiting the opportunity to engage with the company through voting about who sits on its board of directors or what its strategy is. The idea of engaging with a company is certainly hotly debated in terms of how much impact that has. And most of those shareholder engagements, if have any positive impact, are still indirect. Shareholder proposals don't want to be too prescriptive. It's commonly phrased as noses in and fingers out, similar to a board. And any successful proposal or vote, is usually more focused on the corporate governance perspective. So we'd be looking at that incidental impact, again, mitigating the risks related to E, S, or G, and looking for places where the corporate returns are also better, like employment, health, and safety, like we evaluated earlier. That's an area where there might be indirect impact, but it's not necessarily targeted. So the main lever for impact with publicly traded investments is engagement or voting, and ETFs lack this because they are passive investments. So the second barrier is that ETFs are proven to have led to more intense ownership concentration by the big asset managers, which is unfortunate to have that concentration because ETFs are paired with lower oversight, again, by definition. So the shares held, that higher concentration has been debated to lead to lower competition among firms. And also the shares held in an ETF may not actually represent the client's preferences because the manager may not be voting in line with that sustainable label. Even if the ETF is branded sustainable, the voting power, of course, devolves to the asset manager. And they'll often perhaps vote pro-management or at the very least in line with their other strategies. They may not want to split the vote across their strategies for a single company. So the so-called sustainable fund is not guaranteed a vote, for example, climate progress within the holding companies. The holdings in a sustainable labeled ETF may just follow the asset manager's other non-sustainable strategies. Third, this one will be brief, but can ETFs move past the status quo if they're just tracking an index of what's happening? ETFs are, by definition, supposed to track the market, benefiting from the natural trend of market growth. But sustainability naturally means improvement, which seems a bit incoherent here. So are ETFs inherently market followers? And if they are, then how can they be advancing further positive impact? Lastly, and one of the most significant, is the problem of naming self-identification. Does self-identifying as an ESG prove a fund is sustainable? What about the underlying ratings of the companies for ESG standards? Let's start there. The companies within the fund, some ETFs may call themselves ESG or sustainable because they're tracking companies that get good ESG ratings from MSCI, Moody's, etc. But most of these ESG rating services are not talking about impact. Going back to where we started, they're not talking about the impact of the company on environmental or social factors. They're talking about how that company is managing risk related to ES and G. Second of all, the way these companies may be rated is quite unclear, inconsistent. It's all proprietary measures, so it's unclear to understand and compare those things. And there can even be a conflict of interest sometimes because the companies are, in many cases, paying to be rated. So an ESG fund also may include a company that excels on one of those categories, ES or G, but fails on others, like the classic ESG example of Tesla, which of course excels on the environment factor. It helps downstream reduce carbon emissions through zero emission electric vehicles. But on the social side, there's certainly some relatively well-known problems with the company, and the founder of Tesla was actually a bit upset about the ESG score because it didn't reflect the high E, but instead reflected the low S, where the company experienced a COVID-19 breakout in the factory that was running despite public health shutdowns, and had lawsuits about sexism and racism in the work culture. So again, the ES and G can be different, but it's often aggregated under a ESG fund, deeming it sustainable. So all of these same critiques that I just outlined, these concerns that apply to companies, can permeate up through a fund that's labeling itself as an ESG, sustainable, or impact ETF. Is it really? We don't know, just because it calls itself something, what it's actually claiming to do, because those definitions are so fluid, regrettably still, nor if it's actually doing those things that it's claiming to do. So revisiting here quickly the spectrum of sustainable finance capital, this is just showing again how an ESG ETF may not even be trying to achieve positive impact. It may just be considering and mitigating those risks in order to maximize its financial value, let alone whether an ESG or sustainable ETF is achieving those positive impacts. So all of these barriers suggest, to me at least, that ETFs are not the movers and shakers making positive impact happen in the real world. They're market followers. Rather, my colleagues did outline that there's a correlation between ETFs and positive impact. So let's examine kind of some of the solutions here and see how that correlation can at least be improved, and how some of those barriers can begin to be overcome. Okay, so ETFs are mass investment vehicles. So some of the positive factors here, each sustainable labeled ETF can perhaps shift more capital to support a company that's doing good, or normatively could show that consumers, investors prefer sustainability, and may incentivize companies to become more so because capital shifting towards ESG strategies. But let's examine that a bit more closely. The real solution here is related to the naming barrier that I outlined. It would be making it much clearer about the definition of different funds. So better naming rules would make it clear if an ETF is just avoiding ESG risks or actually trying to seek positive impact. The ones I've listed here, which you're more familiar with I am in Europe, the SFDR and CSRD are certainly a really good start here. And it shows that the real answer towards positive impact in any investment and publicly traded funds and ETFs, the real answer here is in better policy, extending the existing oversight that we have on our financial system to areas of sustainability. So, for example, better company details, would allow an ETF to get more specific about what they're holding, a better definition of sustainability, and better consumer transparency about whether that's actually happening. And this is all brainstorming how to, secure and tighten that correlation. Again, this naming wouldn't necessarily lead to causation of positive impact. And let's jump back to some of the other ones. The logic that more capital flowing into sustainable active strategies could be positive. It may require, that active strategies move first if ETFs are a market follower, which is a bit too indirect. Or the idea that more capital flowing into sustainable ETFs would show to companies normatively that investors want sustainable options, so they'll switch to that. I think that argument doesn't necessarily hold true because some questionably sustainable companies are already included in ETFs, sustainable ETF funds. Like the examples that we just used of how certain companies can get positive ESG ratings without actually being so. There's plenty of technology companies in low carbon, sustainably labeled funds that have relatively concerning social and governance factors. So the real conclusion here is that, ETFs are market followers and can in some cases be correlated to positive impact, but are unlikely to cause any additional impacts, but better policy can help get there. It's really important to extend that same oversight as there is for the rest of the financial system, but understanding that the best case, in my perspective, is correlation. And if, in fact, these sustainable ETFs are advancing positive impact, then please nobody tell the asset managers because they will raise the fees for all of us, and that will ruin the fun of ETFs. So thank you so much to Virgil and Observatoire de la Finance for inviting me to speak today. And thank you to Ewa and Adam for opening this with your excellent research.
So thank you very much, Julie, for this terrific presentation. And please feel free to raise your hands and ask questions or remarks that you have on both presentations of Professor Marszk and Professor Lechman, and from Julie. I think she raises very interesting points and more critical elements on the topic of the impact of ETFs. So don't be shy, and please raise your hand whenever you like. Yes, sir.
At the bottom. Okay. Luc Thévenot. And two questions for Professors Marszk and Lechman. On your slides about impact, the three slides that you have where you show green, red, and black, it says ETF. So my first question is ETF generally, or the growth of ESG ETF? Second, the slides speak of impact, but I understand this is a correlation study. So how do you deduce impact from correlation? Thank you.
Okay, so concerning the first question, you asked about the indicator that was represented as ETFs, if I understand it correctly. So the indicator was the value of assets of ESG ETFs. So it was not ETFs at large, but just the category of sustainable investing ETFs. And the second question about the difference between correlation and impact, I think it's a question for Ewa.
Yes, thanks. Of course, I have mentioned that at the very beginning that we do not claim that we are testing causality. This is something different. Although we have some econometric models that potentially can test, of course, using some statistical tests, whether this some kind of model tests the causality or not, in some sense. But still, as I was claiming many times during my presentation, we have been just testing co-movements, okay? Of course, some can claim that this is the impact, real impact, but I would not dare say that this is the impact, especially that I have been telling about the potential limitations and biases and external elements that can violate. Of course, in some cases, we can say that the causality might arise, but in here, it was much more just to see whether in certain fields, of course, measured in a quite standard way as we have it done by international agencies, we observe the co-movements, so the ETFs and the value of other tested element, they go in the same direction or the opposite direction, but it doesn't state the causality or the impact direct, of course.
Thank you.
Yes, sir.
Hi there. Thanks very much for the presentation. My name's John Duncan from Asteria Asset Managers. The study's interesting. Obviously, we're talking about trying to direct capital through the listed markets, which represent the bulk of the capital markets. We're talking about using these vehicles to direct capital towards, I guess, long-term green economic growth outcomes. I guess for me, and so I understand that you're just talking about correlation, but I guess what would be interesting for me is to see whether there was a similar set of results when looking at not just the net asset value growth of ESG ETFs, but to see what that looked like for the overall ETF market, or perhaps for the markets in general, because it would, it would allow us to make some distinction about capital flows in the market. So firstly, just a comment. And then my second question really, Julia, I think comes to you. Two questions really. Do you consider harm reduction to be a positive impact? Because there are many ESG ETFs out there which are, relative to existing products in the market, reduce their level of pollution. These are hard, quantifiable metrics that are rolled up inside of ESG metrics. So just a definitional question around, is harm reduction considered a positive contribution? And then the second is really just to check your thinking around whether engagement, as you've rightfully pointed out, corporate engagement as well as proxy voting are, have no effect. I would ask you to have a look perhaps at the Elroy Dimson study from the London School of Economics, which talks about sort of investors in ETFs are mostly long-term investors, principally pension funds with 20 to 30-year liability horizon, and as a consequence are really the true long-term investors in the market. And the positive side of passive investing is active engagement. And so engaging through time, not just voting at one AGM, but consistently engaging in a strategic way with a collaboration of other co-investors can positively lead to the change in corporate behavior. So I appreciate your comment on that, because it seems like to pour quite a lot of cold water on this idea that engagement has no positive impact. Thank you.
Judy, would you
Should I
like
dive
to...
right in, or was there a question for you live before I do?
Judy, would you like to respond to the question? Or?
Sure. Are you able to hear me? Yes?
Yes.
Wonderful. Thank you so much for the question. So I'll start with the question about harm reduction. I think absolutely that's certainly a type of positive impact, and you cited a great example about pollution reduction. That's one of the most positive impacts that we can have in with a limited carbon budget. is reducing the harm that we create through pollution of carbon emissions. So I think that the question that I'm raising here is more about how you attribute that impact and whether it can be attributed to a holder of an ETF, because it's many ways away. And I think that's something that, you know, an impact-minded investor always keeps in mind when making an investment. Who is that impact attributed to, and what's the additionality of my capital going into that? So for, you know, taking that example of a company that's reducing pollution, you're then going a step beyond to kind of the shareholder, to the fund manager, to an ETF, which an individual perhaps is holding, and it's quite a liquid investment. So is that person's capital on that stack really relating to the harm reduction? That's more of the question that I'm posing here. Similarly, for the question about engagement, I really appreciate the framing that you're mentioning there. But again, what I'm highlighting here is that within ETFs, you tend to lose that opportunity for engagement in many cases because they are passive vehicles, particularly looking at this from the perspective of a retail investor. Again, they're forfeiting their right to vote and to engage on that in most cases by selecting the more passive option. So whether or not engagement is going to be successful in general or in a specific area, there's not the opportunity for that through an ETF.
Sorry, just one quick response, if I may. Could you just clarify why an investor in an ETF is foregoing the right for engagement? If I buy an ETF right now today, and the underlying manager is a provider of an ETF that has a publicly available proxy voting platform, policy, and is engaging collectively on my behalf, as the owner of that ETF, the buyer, in what way am I foregoing my sort of rights around engagement?
Thanks for clarifying. I suppose to be clear, what I'm saying is that in many cases, holders of an ETF won't be personally engaging in the voting or any type of engagement there, and it ends up kind of flowing through a manager, which I understand you're working at an asset manager. Perhaps you're doing things differently, but in many cases, it ends up being voted on kind of by the asset manager, perhaps in line with their other strategies. So in some cases for ETFs, there is not a guarantee that it will be voted on sustainably if the asset manager has a sustainable ETF as well as non-sustainable ETFs. It could just be voted on by one way for that company from the asset manager rather than specifically with sustainability in mind to the proportion of sustainable ETF holders.
Thank you, Julie, for your response. I think there's another question. No, finally not. Any other reactions or questions? Yes, Kelly?
Thanks, Virgil. On the study, and I'm not an academic, so apologies if I'm a little slow here. On the study, the negative correlation with the CO2 intensity in GDP, did you have, I know you're not trying to look at causality, but did you have any predictions or hypotheses about why that might be?
Okay, so yeah, I will respond to that. So thank you for the question. Yeah, of course, that is something that we've been thinking a lot about because it's easy to identify some relationships, but it's much more difficult to explain them. And this is one such relationship. Of course, we can explain it by referring to the portfolios and to the investment strategies of those ETFs, for example, the ones that try to include environmental issues in their investment strategies and that they can in some way promote investments that lead to decreases in the CO2 emissions. But here this is one of the, I think, most of the strongest cases of the linkages that are affected by potentially a large set of variables. So we just noted that at the same time, the assets of ESG ETFs were increasing and CO2 emissions in Europe in those 5 countries were decreasing. And we are able to identify this relationship, but in order to be able to study it in more detail, we would need to include a larger set of variables. So I would treat those results in this aspect as preliminary, and we will try to make more insightful analysis in the future.
Can I just briefly add, it possibly also be let's say, an effect that we have in this case, we have found the positive and very high, negative and very high correlation that now, especially in Europe, all that is environmentally friendly is, let's say, on top, okay? So CO pollution we are trying to reduce, and at the same time, you're observing a huge trend of all different elements, aspects which are eco, let's say, friendly, okay? So this is possibly one of the explanation. Just in terms of numbers, okay? Those two tendencies are just correlated, okay? But we are not claiming that there is a direct effect, of course not.
Thank you for your response. Yes, Madam.
Again, an apology, I'm not an expert in very much of what's being discussed at the moment, but coming at the question from a sustainable development background, it seems to me that in many of the conversations this week, we're trying to retrofit existing financial practices to achieve goals that require a fundamental shift in the way we do business and in the way we finance. So for me, some of the disappointment is linked to the finding that there's a correlation but not causality, and that in so many ways it's incidental in terms of the data sets that we have at the moment. My question is there a sufficient financial architecture in EFTs to go to asset owners, not asset managers, seeking funds for a new way of working? Because there are a number of approaches, particularly at the food, water, waste and energy nexus, that are commercially viable and are demonstrated in Australia, Canada, the US, in Europe, and so on, that it would be possible to have that portfolio specifically linked to a stronger ESG focus, and perhaps some new indicators that would be linked more to acceleration and progress rather than whether we're balancing damage or positive outcomes. I'm sorry, I'm perhaps not clear enough. If someone can help, that would be useful. I'm looking for the system to be recalibrated for purpose to achieve a much higher level of ESG outcomes. Thank you.
Thank you very much for your remark. Adam, would you like to?
Yeah, I think I can briefly answer this question. Maybe Judy can give also some insights. I agree there are many problems related to the current financial systems architecture. Actually, there were some attempts to create ETFs consistent with what you stated, being able to support more clearly selected aspects of sustainable development. However, up to this date, they were quite unsuccessful in attracting funds, in attracting attention of investors. Most money flows to the funds that are quite simple to the conventional funds, with the difference that they focus to a higher extent on the ESG issues. So, for example, they track stock market indexes, but those indexes are adapted in order to obtain higher ESG scores than their conventional counterparts. So yes, that's a very important issue to take into account in the future.
Thank you, Adam. Julie, would you like to react also to the questions? Or
Sure, I can just thank you for the question. I think you're raising a really critical point that I'm sure is being discussed in many panels, or at least on the side of many panels this conference. I mean, I think that's what I was raising in some of the challenges, right? That some financial mechanisms simply aren't designed to achieve positive impact deliberately necessarily. And it's certainly worth kind of lifting the screen off to have a really frank examination of that and think about what solutions we need to move forward if we do want to prioritize productive investments that have positive social and environmental development outcomes. So thank you for the question.
Thank you, Julie, for your response. Yes, madam.
Hello, thank you for both presentations. I'm Esther Major. I have a question about the study and about the sample selection of the ESG ETFs. I assume most of, or probably all of them, are passively managed. How are the indices built? Did you look into how materiality was taken into account for the indices, or was it just general ESG integration without materiality aspects? And I have a second question about this. You mentioned that there's not a lot of fund flows overall into ESG funds. So could the relatively low amount of funds be somehow correlated with positive effects?
Okay, so about the first part of the question, we identified the funds using one of the financial databases. So this is based on the classification from this database. We wanted to make our sample as large as possible, so we took into account all ESG ETFs, not dividing them into subsamples based on the investment strategies. As we mentioned, the number of those funds is still quite low, so this is not only the limitation for the analysis, but also the limitation that you mentioned from the perspective of their possible impact. However, in some European countries, they have managed already to gather some substantial assets, as I've shown in the United Kingdom or Germany. Of course, we could compare those assets to the overall assets of other types of investment funds and state that they are very low, but we believe we have proven through the analysis that some relationships can be observed. Of course, the stipulation that you mentioned was even included in our presentation, so that's something we are totally aware of. What we want to do in the future is to extend our analysis, but by doing the first thing you mentioned, so dividing the funds into various strategies. You also asked about the passive and active funds, and yes, that's totally true. All of them are passive funds, and this is simply in line with the structure of the overall ETFs market. When we want to deal with ETFs, we deal basically mostly with passive funds. Of course, there is a limited number of active funds, but the role is marginal in Europe, in the United States, and in all other regions.
Thank you, Adam, for your response. We will soon finish the session for questions, but I just have a few remarks also on your presentations in terms of the limits of ETF, sustainable ETF contribution to sustainable development. Maybe just two remarks, if any one of you can reflect on them. The first remark is concerning the regional imbalance in the sense that I know your study is covering the European market, but if we think of the contribution of sustainable ETF to sustainable development, we notice that the market is mainly based in Europe, and ETF are almost absent in developing economies. So this is probably a big limitation to the contribution of ETF to sustainable development. The other one is the coverage in terms of SDG, because sustainable ETF contribute to a certain number of SDGs, but not all of them. and if you see any solution to improve that. And maybe another general remark, we had 2 great presentations. Your presentations were indicating that sustainable ETF can contribute, at least there is a strong correlation that they can contribute to sustainable development. On the other hand, Julie brought some very interesting element, more critical element, on the fact that sustainable ETF are more market followers. They may not be active enough to really contribute to sustainable development. So I wanted to ask to Julie, are sustainable ETF too passive to be really sustainable? I mean, is it, can we, because the promise of sustainable ETF is that you can have some kind of passive instrument, mass development instrument that are passive, but at the same time they can contribute to sustainable development. But from what I heard with Julie's presentation, it's a bit challenging because from what she argued, it looks like as if they are too passive to be really sustainable. So these are my remarks.
Yes, so the first one about the geographical coverage of our analysis and actually of the ETFs industry. So that's, of course, very true, because when we consider not only ESG ETFs, but generally all types of ETFs, we can see that it is mostly the advanced financial systems plus a few emerging ones, but in the vast majority of the world, those funds are simply not available. So this is one of the most substantial barriers to be overcome if we want to expect them to influence sustainable development globally, in particular in the developing emerging countries, because the funds in Europe can potentially affect mostly the European socio-economic systems and environments, not the ones located. Of course, they may, through some indirect effects, affect also other regions, but we can state that those relationships will be quite weak. The comment about SDGs, that's also true. So we tried to analyze variables representing all SDGs. So that's why there were 26 on the list that Ewa presented. But unfortunately, it was very difficult to find variables representing some of those SDGs that could be related to ETFs markets in a way possible to explain. So we could use, for example, variables representing some type of wildlife protection, but where is the relationship, how to explain it? So we would think that even if the correlation was strong and, for example, positive, it could still be spurious. So that's the issue. Related also to the construction and the assets held by the ETFs that are available now. Maybe this will change in the future. There are some funds that focus on specific SDGs, but their number is quite low. So those are funds that are not general as ESG ETFs, but ETFs related to SDG number X.
Thank you.
Just want to what Adam was saying and your comment about the geographical scope. In one of our past studies, we have been also testing the ETFs outside Europe, and it was quite interesting that there are 2 markets where those ETFs were expanding. It was South Korea and Mexico. Yes, where their share in the stock market was absolutely massive, even higher than in US, as far as I remember. Yes, so especially in Mexico, the development of those funds was quite impressive, and also about the Europe, what probably it was in the presentation, but you didn't mention it now. The development of ETFs, even within Europe, is highly diversified. So there are countries like Hungary, Poland, where the impact development is absolutely marginal, but some others where it's quite well going.
Thank you. Julie, are ESG ETF too passive to be sustainable? Do you have any reaction?
Merci pour la question. I mean, you would have heard a healthy dose of skepticism, certainly, in my presentation. ETFs are by nature passive vehicles, as Adam had mentioned earlier. I think ETFs have had a wonderful impact in terms of consumer finance and accessibility of public markets to retail investors, and that's certainly a positive impact in and of itself. But in terms of advancing the really critical environmental and social issues that we're facing that the SDGs encompass, I would see ETFs as market followers and not able to be too passive to be at the cutting edge of driving positive impact forward, and perhaps just being able to kind of support things that are already happening.
Thank you, Julie. Thank you to all of you for your reactions and questions. Now I will give the floor to Professor Paul Dębiński, who has some conclusive remarks for the panel.
It's a very interesting discussion, raising many general points and very specific ones at the same time. My few words are just on the general side. I think that we are here in the workplace where there is a work under construction going on. We have been called, all the initiative is called building bridges. So many bridges have been mentioned, but I would add maybe one which seems very important, especially in this conversation that we just had, the bridge between the management and the finance. So real economy is the real playground for sustainability, for ESG and so on. So finance can be maybe a radar where some of the elements are captured, but the signals coming from finance have to be captured by real economy managers and by real economy enterprises. And I think this is a kind of weak link, because sustainable finance or finance sustainability is progressing in the field of ambiguities. And I would like maybe to address one of these ambiguities, which has to do with the term of investment. The term of investment is both used in finance world, which means buying or selling assets, and it's used in economic world, which means providing the resources to build real economy facilities. These two do not necessarily overlap. And when buying an asset on the financial markets, it does not affect directly the real economy decision maker. So how to affect the real economy decision maker? There are two ways of acting. One has been mentioned: active shareholding, long-term shareholding, conversation with management, and so on. There is another one which has been pledged in many research papers and in economic literature, is about mechanical relationships, saying, well, there will be an effect on price, on share price. This effect on share price will have an effect on capital cost. The capital cost will encourage management to act in one way, in sustainable, compliant way. I think the second, if the first one, the long-term holdings, is something which is practiced in some very active funds, but it's not necessarily good news for massive financial activities, because massive financial activities do not like very much long-term shareholding, because simply it's killing commissions, and most of the finance industry is living on commissions. So I think this is an important point. So long-term shareholding, yes, but it will probably not become a general practice. What about the other avenue, the mechanical avenue, which I call a mechanical avenue, the avenue which would go through the price effect and the capital cost effect? For the time being, the studies show that if this effect exists, it's very low, and it seems to not have a significant impact on cost of capital. So the third way I was mentioning started with two ways, but there is a third way to build an intellectual bridge between sustainable finance and management teams, board teams, to change and to adapt their way of acting and to adapt their investments without even waiting for long shareholder signals or without waiting for capital market signals. So this is the first general remark. There is the second general remark, I think, which is important when we have been looking at different instruments and institutions working in ESG. and related ESG to sustainable development goals. Sustainable development goals present a holistic picture. When we look at different ratings and different approaches, at the company and the financial level, it's more on pick and choose. So this fragmentation of something that was supposed to be holistic into bits and pieces is not constructive probably. It's destroying a little bit of the idealistic vision of SDGs. And fragmentation is good for mathematics, but probably not for the common good. Finally, the third general remark, I think, is the risk of disengagement. If results do not appear in a significant way in a short period from now, there might be a disengagement of finance professionals, disengagement of potential shareholders, and finally, disengagement of top management. So I think we are in the building place, we are in a work in progress, but this progress has to be speed up, in order not to lose the initial enthusiasm that was behind the finances for sustainability initiatives. Thank you very much for your attention.
So thank you very much, Paul, for your final conclusive remarks. Before closing the session, I just would like to mention that we at the Observatoire de la Finance, we organize a global prize for young professionals and academics under 35 years old. They have to write an essay in English on issues related to ethics and sustainability in finance. There's an award of $20,000 for the winners. The deadline to participate is 29 May 23. So if you would like to participate, or if you know young academics or young professionals who may be interested in participating, we have some documentation on the table here, some flyers with all the information, and also some, we print the essays of the winners in a review, which is available here, and we have also a volume compiling all the essays. So please feel free to take some documentation when you leave the room, and thank you very much for your participation and your attention.
Thank you, everyone.